Hey, what's up you guys? Swan here from Swan Things. So it's been a while since my last video, but with the markets taking a dump, I've been taking some time off to do some much needed research. Now, if you've been invested in the markets for the past few months, chances are you're experiencing a little bit of bleeding in your portfolio. Now, for many of you, this might not be your first rodeo, but for those of you who are experiencing a crash for the first time, you might be second guessing your investment decisions right about now. So in today's video, let's take a breather and put things into perspective. We'll be taking a logical look at market crashes, but more importantly, we'll be looking at recovery strategies, specific examples on how to turn this crisis into an opportunity. So without further ado, let's begin. Before I get into why the market gods have forsaken us, let's take a look at market crashes in general. There is a saying that all past market crashes look like opportunities, whereas all current and future crashes look like risk. Lots of people look back at the 2020 crash or the 2017 crypto crash and wish they had bought the dip. But ask them about the current crash and they'll be sitting on the sidelines. This time is different, they say. The risks are higher. And so the cycle continues. This illogical thinking is thanks to fear and lack of preparation. Market crashes are an inevitable part of investing, so let history be your teacher. The stock market experiences a full-on crash every 10 years or so, and many more mini crashes sprinkled in between. For stocks, every single bear market in history has been followed by a bull run. In fact, the average bear market in the US lasts 1.4 years with an average total loss of 41%. But the average bull market lasts 9.1 years with an average total gain of 480%. At home, our very own Bursa Malaysia shows the same trend, even though returns are less impressive and our bull runs don't last as long. Even Bitcoin, a whipping boy of the recent crypto crash, has seen its fair share of bear and bull markets, bouncing back stronger each time. So while any losses may haunt you in the short term, sit back and think about the long term. Market crashes will come and go. Investing is a marathon, not a sprint. But not all investments can be expected to recover over time. So how do you decide whether to sell and cut your losses or to double down and buy the dip? Well, there are a few time-tested strategies that can help you make an informed decision. The first step is to step away from your investments and to reassess your financial situation. Before you even think about whether you should sell your investments or to spend more money to salvage it, you need to ask yourself, do you have the holding power? Holding power is the ability to hold on to your investments without selling. Investors with a strong holding power should have enough cash flow stability to cover their expenses and commitments. They should also have a fully funded emergency fund at their disposal. If you have these areas covered, you can then determine whether you have any extra cash to put towards your recovery plan. Again, this should be cash that you don't need to use for the next 3 years, because there is no guarantee that the markets will recover in the short term. The next step in recovery is to know your options, and in general, you have two. The first is sell then buy. Now, this isn't necessarily selling and buying the same investment, it could be a rotation to a different investment. The second option is hold and buy, and this usually refers to holding and buying the same investment. Now, to understand which is the better option for your specific investment, you'll need to redo your fundamental research and figure out why markets are crashing in the first place. Did the fundamentals of your investment change? And if so, is this change temporary or permanent? If the fundamentals remain strong, the investment will continue to do well over the long term, regardless of short-term market noise. And so the best option is to hold and buy, averaging down on your entry price by taking advantage of discounted prices. I'll give you an example of how this works. Back in early 2019, I had the good fortune of buying 4,000 ringgit worth of public bank stock at its all-time highs. So naturally, the stock decided to take not one, not two, but three huge dumps over a span of a year. After a year of rickrolling, I found myself down 40% on one of Malaysia's strongest blue chip stocks. Good times, good times. But, anyways, luck was on my side in 2020 because I received a pretty decent performance bonus at work by the end of March 2020. And so I decided to put 3,000 ringgit into public bank near its lows and another 3,000 back in May, which lowered down my average entry price. Fast forward to today, and I am up about 20% on this counter in capital gains alone. So you see from this example that if the investment is solid, even if you buy at all-time highs and the prices don't fully recover to your initial buying price, it does not mean that you won't get your money back. By buying the dip, you can average down on your entry price and still make a profit when recovery eventually sets in. So do your research and know the fundamentals. If the fundamentals remain strong, hold and buy the dip if you have the means to do so. Now, the reason why sell then buy is not a recommended option for this scenario is because it assumes that one, prices will continue to fall, and two, that you can perfectly time your re-entry. Selling an investment simply locks in a guaranteed loss with no guarantee that you can buy back in at a lower price. If you can do it, more power to you. But more often than not, you might be missing out on a lot of gains if you fudge the timing. But what if the fundamentals do change for the worse? Well, in this case, you'll have to assess whether the change is temporary or permanent. Temporary changes in fundamentals will give you more options because you can still choose to hold and buy. Permanent changes, on the other hand, will require you to cut your losses and look for opportunities elsewhere. Not all investments can recover over time, and it is not always a good idea to buy the dip. Investment is dynamic and ever changing. Even good companies with strong fundamentals can experience a sudden shift that no one can ever predict. So don't beat yourself up because you're not the first to make a loss and you won't be the last. Take the loss as your investment education fee and move on. There are plenty more opportunities to be had. A good example of a fundamental change would be AirAsia. It is no secret that this once promising business is facing a series of crushing blows from the pandemic, which no one could have possibly predicted. With expected vaccination rates still low in the ASEAN region and the company racking up debt and losses like there's no tomorrow, the fundamentals for AirAsia are no longer what it used to be. Any recovery, if at all, will be a long and painful process. Even if the price seems like a high value play, it's a risky one that may take a long time to pay off. Lastly, of course, we have to talk about cryptocurrencies. Cryptocurrencies have been hit with a triple blow, causing a massive sell-off from an overheated and highly leveraged market, not just in Bitcoin, but across all cryptocurrencies. The first criticism on sustainability is valid. Bitcoin mining does consume a lot of energy. And even though there are reports that say that most of this energy comes from renewable resources, this report is financed by firms that have an active interest in cryptocurrencies. While most people can agree that Bitcoin will become more sustainable as green energy becomes cheaper, this transition will not happen overnight. The second trigger really isn't that concerning because it simply tightens monitoring on crypto transactions to prevent tax evasion and money laundering in the US. As for China, even though they have always maintained an aggressive stance against cryptocurrencies, this new warning comes with a bit more bite because it targets Bitcoin mining specifically, something they have turned a blind eye on for the past decade. Although no specifics have been announced, we can expect more details and clarity in the near future. There is nothing an investor hates more than uncertainty. So until we get more clarity from Chinese regulators, we're in for a bumpy ride. Nevertheless, crashes like these are nothing new and should be expected for the crypto space. If you're in it for the long haul, fall back on fundamentals and think long term. Don't invest more than you can lose and you'll do just fine. And that's all I have for you today. Market crashes are an inevitable part of investing. So think long term, follow a couple of golden rules, and there is no doubt that you'll come out the other end stronger than before. Don't be afraid to make mistakes and keep an eye out for opportunities because more money is made from market crashes when good investments go on sale. Thank you so much for watching. Smash that like button and subscribe to my channel if you haven't already, and I'll see you in the next video. Bye!